Hey guys, today I'll be discussing section 11.2, which is just talking about now recording sales transactions using a general journal. So we're still talking about the general journal that we used in 11.1, but for 11.1 we did transactions for purchases. Now we're doing transactions for sales. So how would we record a sales transaction using the general journal? So we talk about this new account called sales returns and allowances. Just like we have purchases, returns, and allowances for when we would make a purchase, we also have sales returns and allowances. So when something is returned, so if I return something to 3Greens Products, I record it one way on my accounting books. They record it another way on their accounting books. So for me, it's a purchase return. For them, it was a sale and they're getting that in return. So they're making a sales return because when I originally bought my product from 3Green Products, they recorded it as a sale. But now I'm returning it. So they have this account called sales returns and allowances to keep track of how much they returned to people, how much credit they allowed people to have because of mistakes. So a sales return is a credit allowed to a customer for the sales price of the returned merchandise, resulting in a decrease in the accounts receivable after the merchandising or accounts receivable of the merchandising business. So that's basically saying that the customer is returning something, decreasing their accounts receivable on the books. Because if they return something, it says, okay, we no longer owe you this money of $300. Sometimes a company will allow a sales allowance, which this is a credit granted to a customer without them actually returning the merchandise. They just get this credit, typically for the sales price of the merchandise that's returned. And this also decreases their accounts receivable. So we have this account sales returns and allowances. We talk about a credit memo. We had one of these before in 11.2 as a debit memo. This is for purchases return, so this is on the customer side, but this is on the company side now. They say, okay, when we make this return, here is the credit memo. So it's the same transaction. Let's say like I'm returning something to Sales Green. We learned about what that looks like for me in the first section of this. Now, what does it look like for 3Green? How do they record that? So here's that first transaction, and it says, on December 16th, we granted credit to Lake Automotive for merchandise returned, $65.85, plus the sales tax of $3.95. From S500, total was $69.80. So when we usually make a sale, the customer owes us money in sales tax. And so that doesn't just go away. So we have to show like how much of that sales tax was the purchase and also decrease that out. So when we originally made the sale, we would look back at whatever it was. So for purposes of this, they gave us information. So we returned they returned merchandise. So we have sales returns and allowances for the $65.85. We have a new account called sales tax payable, and we you've seen this before, so it's not no, but for this right here, we have sales tax payable, and we debit it. Then the rest comes out of the difference comes out of their accounts receivable. So I want to write it down just for you to get a picture. You can see it in the T accounts down here, but when they originally bought the items, it would be an increase to their accounts receivable for $69.80. The sales tax payable is a liability, and it increases on the credit side. So it would have been $3.95, and we would have had a purchase for $65.85. That's based on this problem. So we would have increased our purchase it's revenue. We would have increased our payable because part of that goes to taxes. And then they owe us this full amount. But on our books, we see, okay, increase in purchase, increase in tax payable, and they owe us $69.80. Now they're returning it. So you literally just flip this. This becomes $395 for sales tax. I didn't write. Sales tax payable. So now we're zeroing this one out. It becomes 0. The accounts receivable, we credit for this full amount. 0 that out. And the account that we use now to show what we've returned is this sales returns and allowances. And then normal balance of that is a debit, so it's $65.85 for whatever the purchase was. So we just do the opposite, and we get these two to 0 out. In this case, if they had $400 in accounts receivable and all they returned was $69.80, it would just bring our balance down to a new balance. Okay? So that is journalizing the sales returns and allowances. You're just doing the opposite. Then you post. So you post from the general. And because it's an accounts receivable always goes to the accounts receivable ledger, just like the accounts payable ledger we had learned before. So you do the same thing. You post any accounts receivables to the accounts receivable ledger. And we have our posting here. Then we can post from the, they don't show that, but you would post all of these then. Okay, so you first post the accounts receivable, and then you go through and you post the rest of the entries in the general ledger. So we post to the accounts receivable ledger first, then the general ledger. This just talks about correcting errors in a subsidiary ledger account. The subsidiary ledgers are the accounts payable and the accounts receivable ledger. So a subsidiary ledger, we had learned this before, is the accounts payable and accounts receivable ledger. These are subsidiary. Okay, it's just a name that they use. So here's the transaction. We found that a sale on account to Skinner College was incorrectly charged to the account of Wells Apartments for $334. Okay, so we found an incorrect value. So the first thing you do is the date, and then you write Skinner College. We found that the sale on account to Skinner's College was incorrectly charged. We need to record it in Wells, and it was incorrectly charged to Skinner's. So we go ahead and debit the full amount to Skinner College, credit the full amount to the Wells apartment, and then you need to make sure that you put it in the correct postings. So then they post it to the correct subsidiary ledgers. So that's just in case we find an error. You would just do the opposite of what it is asking. So again, if we found that a sale on account to Skinner College was incorrectly charged to Wells Apartment, we need to get it out of Wells Apartment and put it into Skinner College, because accounts receivable is normal balance, a debit. Okay, so tune back into 11.2, work together problem.